From a tax perspective, would it be better to gift a beneficiary from trust assets while the grantors are still alive?
Boy, deja vu?
Yeah, what? Same thing?
Yeah, so would it be better to gift a beneficiary from the trust assets while the grantor is still alive?
Mm-hmm.
I have mixed feelings on this because I've kind of dealt with this. If the grantor is in poor health.
I know what you're talking about now. It took me a while. I'm a little bit slow today, guys. Jeff's referring to something that we were talking about.
Yeah, if the grantor is older and poor health, then no, you don't want to distribute those assets if you can't. There's multiple reasons to distribute to the beneficiaries. You may just want to be able to, if it's your children, to benefit those children while you're still alive. Maybe you'd rather see them get some of it while you're still alive than after you pass. However, if you wait till you pass for them to obtain your assets, they do get that step up in basis, and that could be a considerable benefit to them.
Mm-hmm. Boy, I just dealt with this actually on a question that we couldn't answer a few weeks ago. I've been going back and forth with the client. It was some Oregon clients. We were talking about the inheritance tax, which Oregon still has a inheritance tax, which is called the estate tax there, but basically it's an estate tax. They call it the inheritance tax, excuse me. It's not $1 million. Like, so anything above that, you're getting hit pretty hard. And so here's the competing interests. If you die with an asset, the basis steps up. So let's talk about having a house. And I give the house to Jeff during his lifetime. Let's say I'm Jeff's dad and I'm giving him the house. Then there's no 121 exclusion. Jeff is getting my basis in that. Let's say that I bought it for 30 years ago for much, much less than what it's worth now. And he's not getting taxed on it, but he's not getting any benefit, and I'm not getting any benefit. Now, if I pass away, Jeff owns the house. He gets no step up in basis. I've already given it to him. And he could do whatever he wants with it during his lifetime. So if I give him the house and I say, here, Jeff, I'm going to give you the house. And he says, great, Toby, you're moving out tomorrow. I'm kicking you out. There's not much I could do about it unless I reserve a life estate or put it in a qualified personal interest trust, something like that, or personal residence, QPERT, qualified personal residence trust, where I get to live in it for the rest of my life. Now, we don't want to lose that step up in basis that you get. So, let's make it in reality. I'll give you a real life situation of somebody who inherited the dad put some buildings into a limited liability. It was actually a limited partnership, but it could have just as easily been a limited liability company. And they gave the interest to a bunch of siblings. And they did not get a step up in basis. So when the siblings sold it, they ended up having tax obligations when they started selling off the buildings years later. And that kind of stunk. And the reason they did it was because they were worried about the estate tax, but there really wasn't an estate tax to worry about. It was just some advisor getting a little, jumping the gun, getting out over his skis, getting worried about something. And it caused tax harm. The only time I would actually recommend that somebody starts gifting the asset is if we know for sure there is going to be a tax hit. So mom is getting older and I am going to pay $140,000 in tax. I just did the numbers on one of these and this is about the scenario. Is that more than I'm giving up if I have a step up in basis? And so I look at it and say, if I gave up the step up in basis and just transferred it now and I sold it, what would my tax obligation be? And if I ran the numbers and it was less than $140,000, then I might do it, assuming that mom's old and in poor health. Because I'd say, hey, I'd rather not get killed in taxes. Right. It's not worth it. I'd be better off. Here's a thought though. Whenever I see those situations, I always go to them and say, what are you trying to accomplish? Why doesn't mom sell the house on an installment sale with the right to occupy and pay rent? And that way we froze the value of it. It stepped up at that time. Mom has an income stream, and then you just gift the income stream when you pass. You kind of get the best of both worlds there. You got it out of your estate. You froze the value of it. Anyway, so and there's some other little tricks up our sleeves too that we could use.
And as far as gifting to your beneficiaries or to whoever, one thing I would recommend based on what Toby just said is I don't think it's usually wise to gift greatly appreciated assets.
No.
Because you're just transferring your tax liability to them.
Absolutely, 100%. 3 rules of anything tax or financial related, which is calculate, calculate, calculate. That's where we just get our pencil out. And in most states, I think there's 14 states now that still have an estate tax. Most of the time, the federal taxes, unless you're over 11 million, it's not even an issue.
Right.
If it's married couple, unless you're over 22 million, we're not even worried about it. But you may live in a state that still has that stupid estate tax. So like we had the Oregon, they're at $1 million. Some states are still floating around out there. So you always just get it out and say, what would I be looking at? What am I giving up? And you don't make a hair trigger reaction. All right.